Thanks for tuning in to this episode of the Resilient Advisor Show. My name is Jay Coulter, and joining me for this episode is David Barse, the founder and CEO of XOUT Capital.
Our mission at Resilient Advisor is to have a significant impact on the retirement crisis by educating and empowering financial advisors to better serve their clients. We bring you industry thought leaders and experts to help you make a difference in the lives of your clients.
Every ETF has a story, and some of them are worth telling. I'm excited to bring David Barse onto the show to talk about XOUT Capital and their popular ETF, XOUT. David, tell listeners, since this is your first time on the show, a little bit about your background.
Jay, thanks again for having me on. This is pretty exciting for me. So I have a long background in the asset management industry, which has been very insightful in terms of helping me create what I'm doing right now, which is XOUT Capital. I spent almost 25 years helping build a value asset management firm called Third Avenue Management, which had its roots in distressed investing. So my actual background is as a bankruptcy attorney, and I flipped into the investment business when I learned it's much more fun and rewarding when you make money on the investments than charging by the hour for what you do for your clients with the investments. So helped grow Third Avenue and learned a lot from that experience in terms of the right things and the wrong things to do in the asset management business. And it led to three important insights that gave rise to XOUT. So I can tell you the three insights. The three insights are, one, from being in a actively managed value shop, watching the growth of passive index strategies just trouncing the active strategies year after year after year. And I'm firmly of the belief, and I think this will continue on into the future, that passive strategies will dominate flows into the industry, probably forever. Insight number two is it's much harder to pick winners than to eliminate losers. And this flipping of the investment paradigm, which XOUT represents, that is, we just focus on what to exclude from a broad-based portfolio. And I posit to you that is much easier to do than trying to identify what the few winners will be, time the market appropriately, enter them, exit them, and then outperform over the long term. And insight number three is the probably single most forward-facing risk we all have to deal with, and mostly companies and securities that we invest in, is technological disruption. And if anything we learned from this last year, what an event that is unforeseen can do to accelerate technological change and how that impacts businesses, it is a very important risk. So the XOUT ETF, our first ETF, which is for a large cap universe, is designed around those three insights.
Excellent. And we're going to get into the specifics of that. We're going to go through the traditional 4 Ps when we talk about this. We're going to talk about the portfolio, the process, the people, but really let's start with what actually kind of matters, and that's performance. So I'm going to pull up a chart for podcast listeners of the XOUT performance since their launch. And to speak to it before you do, David, for podcast listeners, since launch, it's up about 900 basis points over the S&P 500 total return index. And then as I pull up a chart, a technical chart, you can see that it is sitting well above both its 200 and 50-day moving average. David, what's driving performance of the strategy?
Yeah, it's really as simple as just by avoiding those large market cap companies. Again, we start from a constituent base of the largest 500 US listed equities. So if you just eliminate from that universe a number of the large cap stocks that have trailed and are likely to be disrupted and continue to be disrupted by technology. For instance, something like Exxon, Chevron, AT&T, Verizon, to name a few, just by avoiding those 4 companies was a massive contribution to our outperformance. Because what we end up doing, and I don't want to get too ahead of myself on performance, but this is an important criteria to this, we take the market cap that we've excluded and we apply it to the remaining securities that are left in the portfolio and gross them up pro rata. So by consequence, Apple becomes an even larger exposed company than it would be in, for instance, the S&P 500. But it's really more about the excluding of Exxon and Chevron that was the contribution.
So let's get into the process, but first, the people. What's the intellectual capital behind XOUT?
Yeah, so I, as I said earlier, spent a long time in the active management world. And one of the important components of the people of this was myself, in that I had to come to grips with the fact that a human being making investment decisions is flawed. You have to be a superhuman to outperform the market and do that consistently. And consistent is a dirty word, right? Because nobody really does it consistently. So you need to have what I determined right off the bat is it has to be a rules-based methodology. Now, in building that rule, it took years to vet through what are fundamental financial metrics that can help me in determining what to eliminate that is or likely will be disrupted by technological change. So one might obviously recognize that technology companies are going to likely thrive, although this is not a technology-derived strategy. And companies that are in retail, energy, real estate, utilities are likely to continue to get disrupted as we move on in time. So getting that kind of input into the building of the methodology, I outsourced virtually many of the building of this model, of this rule. And I used a firm that you know called EQM Advisors. Jane Edmondson was extremely helpful in working with me to design the methodology. And there were also a few other analysts who are specialists in quantitative analysis that helped in deriving the model as well. But ultimately, it was really my doing in creating this methodology. And I'm working on it for other passive indices that are attracting flows as well, like the mid-cap space, the international space, the small-cap space. But we started with the large cap first, the proof of concept.
So the people behind XOUT are yourself, and then you partner with index providers that help you with the methodology. Is my understanding correct?
That's correct.
All right, so let's talk about that process. Soup to nuts, how do you go about constructing the index?
Yes, so again, we start with the constituency, and that's an important point for me to make because if you think about the S&P 500, which is a benchmark that we like to compare ourselves to, that index is probably the most actively created index out there, even though it's one of the most dominant for the large cap space. You have to really make your rule and then stick to your rule. So let's pick on S&P for a second because they made an override decision to exclude Tesla from their constituent base, even though it had qualified under their methodology statements, right? Mm-hmm. Our methodology statement stands for itself. We take the largest 500 companies. They must be listed on a U.S. exchange. They have to have at least 4 quarters of profit. So we end up missing out on new IPOs because an Airbnb, for instance, would qualify by market cap, but it doesn't qualify yet because we haven't had 4 quarters of profitable earnings yet. So once we gather that constituent base, then everything changes. That's where the paradigm flips, where we're just focused on what to exclude or X out. And everyone else in the universe, I think, is very focused on how to identify the winners. And I just think that's a really hard thing to do. And we just focus on the losers, and we use our scoring system. There are 7 factors that go into the score that are based on fundamental financial data that we receive every quarter as they file financial statements. And we give all 500 companies a score, and the bottom 250 are excluded.
And so is the rebalance is quarterly? What's the turnover been since you've launched?
You know, we're about 60% turnover, so not even a full turn on the portfolio in our first year of existence, which was what some of our back tests showed might happen. And that's actually something I'm proud of. You don't get a lot of high vol turnover in the portfolio. And that's because this is really about unearthing long-term secular decline. If you're being disrupted by technological change, it's a hard ship to turn. I'll pick on one company as an example of that. IBM is in the midst of trying to do that with their merger with Red Hat. their scores have not improved enough to get them back into the portfolio after having consecutive declining growth for, I think, 8 or 12 quarters. It was some crazy number like that. So they're trying to turn it. It's a difficult ship to turn, but if they ultimately do turn it and start to grow again, which is an important metric in our model, then they might get included back into the portfolio. But currently they're X'd out, and that's why we don't have a lot of turnover. You just don't. It's a tough one to turn yourself back in.
So then, given the fact that you are Xing out companies that you think are in either secular decline themselves or the sector is, what are some of the industries that you see headed down that path?
Yeah, as I mentioned, energy is probably the biggest in terms of its market cap exposure. The energy companies, by their own statements in publicly disclosed materials, acknowledge that the demand for the primary product that they deliver is declining year over year and may at some point in time reach equilibrium and actually be in a permanent decline in 20 years, right? And so you look at that, it is a long-term secular pathway, if you will, but they're troubled in terms of being able to keep up with the growth of some of the other larger companies in our constituent base. Real estate are other companies. It's tough. Obviously, the pandemic exposed, especially commercial real estate and large retail real estate REITs, how difficult it's been for them to operate in this environment. Utilities are obviously different kinds of securities. They're more dividend oriented in their structure than they are in growth orientation. So naturally, in our model, they'd get X'd out. And then you have, communications, but of course, the S&P have now changed what was once the communications sector, right? You only had 3 stocks left in it when we started, and now that's different. But AT&T and Verizon, again, you listen to them talk all day long about 5G and how that's going to be impactful on technological change, but it's so much has got to get invested, and you have a long time before that's going to make a meaningful contribution to their bottom line, and they are heavily debt-burdened companies. So they have scored poorly in our model consistently and have been X'd out. And they're big market cap companies. So you think about that, how are we getting our outperformance? Just by avoiding them, you're able to do better. And that's a low-risk way of handling things.
So for podcast listeners, the top holdings in the fund as of this recording are Apple, Microsoft, Amazon, Google, and Facebook. And then for good measure, Tesla is number 6. IT makes up 40% of this portfolio. David, what do you say to a portfolio manager who's building out a strategy, thinking about adding this, but with the heavy tech bias as it sits today? How do they account for that in their models?
Yeah, look, I mean, they should recognize that this is probably not too dissimilar to a lot of the large cap and even some of the more thematic smart beta strategies. These companies are dominant positioned in portfolios for a good reason. They just continue to perform well every single quarter and exceed the estimates of what most of the market pundits believe these companies can do. Now, is there a theoretical possibility at some point in time a company like Facebook could get X'd out? It's definitely theoretically possible. But the fact is we're basing our decision-making on fundamental financial metrics, and they continue to exceed expectations quarter on quarter. And that's the reason they're in the top. It's for no other reason than performance of their own doing, and investors should be rewarded from holding them, not worry about valuation if we want to get into it, because I think what the marketplace still hasn't warmed up to is that they have to rip up traditional valuation metrics and stop saying the market's expensive, because their brains haven't yet factored in that technological disruption changes the paradigm for valuation. And the pandemic exposed everybody for that. And still people say, boy, the market's so expensive. Yeah, it's expensive for United Airlines that people started trading at prices pre-pandemic because they were going to come back and people were going to start flying again. And then boom, you get hit with a quarterly earnings report like we did the other day. And people wake up and say, whoop, I guess they're not there yet. But when they see the quarterly reports for those 6 stocks that you're about to get this coming week, people will be like, wow, they did it again? How'd they do it again? Why is it such a surprise for everybody? I don't understand.
All right, so I'm going to pull up a screenshot that I'll speak to for podcast listeners, and this is from your website. And really, this is what kind of turned me on to us sharing this story. Perhaps more important than what you put in your portfolio is what you leave out, in graphics of some old, well-known brands such as Blockbuster, Pan Am, Polaroid, Toys R Us, and Compaq. David, this tells the story of the XOUT process.
Yeah, look, I mean, quite frankly, some of those names might outdate some of our listeners, but you can put Macy's on the list. You know, I mean, Macy's was at one point in time an S&P 500 company. It's no longer. And there's a reason for that. It's just market cap has deteriorated, and yet everyone talked about it as a great value stock to own because of their real estate. You know, it's the companies like Visa. Like, I'm sure that might surprise some folks. Why is that company, which is a technology company, classified as a tech company, so it's our largest XOUT, they've continued to struggle and in growth, and have had components of their business sort of pecked away at by payment companies, which are the disruptors. Now, if I was really smart, I'd create a portfolio of high conviction names in the payment space that are eating Visa's lunch. But I'm not smart enough to figure out how to do that. I leave that to other people to figure out. For me, own a broad portfolio, wildly diversified, and just don't own Visa, and you're going to do pretty good. The rest of the names, probably Disney is another one that surprises you. Can we not have another journalist or market pundit talk about their Disney Plus and how many subscribers they have and how many subscribers they're growing? Yet, what is the actual contribution to the bottom line of the business that size? It's less than 10%. And so why do we keep talking about it and trading that stock up? Like they'll announce, oh, we're opening our park today, but no one can actually go inside it. So how come people think it's one of these, you know, go-getter securities that everyone should own? Its score in our system has consistently failed to get it into the portfolio. And so it's been probably our number one detractor, actually, in the near term, because it's performed well as a security. But I stand by our process, and I'd say that at some point in time, there'll be an awakening about when Disney will actually be able to generate true profit with all the money that they're investing in their streaming services and the other things that they have to make up for what the pandemic has done to that company.
Excellent. David, I appreciate you coming on and telling the story of XOUT. Financial advisors, here's why I think you should put this on your radar. If you have clients that are looking for that hot stock idea or continually like to talk about the markets, and you want to put them into some type of holding that has a rules-based process, not for necessarily just picking the winners, but eliminating some of those losers while at the same time delivering performance, this could potentially be something that you could add to your models. David, thanks for coming on. Podcast listeners, please visit XOUTCapital.com. That is XOUTCapital.com to learn more.
Jay, thanks again for having me. It was a lot of fun.
Are you struggling to hold your team accountable? Do you struggle getting them to see your vision and drive results? The Resilient OKR system for financial advisors could be your solution. OKR is an acronym for objectives, which are your big inspirational goals, and key results, which are how you and your team are held accountable. This is the Silicon Valley method that drives growth at major companies such as Intel, Google, BMW, and Disney. Move your business results away from opinions and measure it with data.
Pick up your complimentary access to the Resilient OKR system for financial advisors by visiting resilientadvisor.com/OKR.